Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. I'm your humble host, Troy, and today I have the pleasure of speaking with Dividend Daddy from Twitter or X, whatever you want to call it. Dividend Daddy, if you wouldn't mind giving yourself a brief introduction and telling the people a little bit about yourself.
Sure. Thanks for having me, Troy. Appreciate it. Dividend investor, hybrid investor. I started out in my, early to mid 20s. I'm now mid 40s, investing initially in index funds, ETFs. And as I've gotten older, into my 30s and 40s, I turned hybrid and started to invest in a mix of index funds, mainly for diversification outside of my home country, which is Canada. And of course, the individual stocks, primarily in Canada, with some US stocks as well. I don't know what else you'd like to know about me, but that's a little bit to get started.
Yeah, no. That's a really good intro because a lot of people will just, keep going and answer all my questions before I ask them. So I appreciate that. So, you kind of spoke on this first one already. So when did you begin your dividend investing journey? You said like mid 20s. And then what got you to transition more specifically into those individual stocks as you're getting closer to your retirement goal?
That's a good question. So like I said, I started in my early to mid 20s, sometime, I can't recall because it's been a while now, investing. And I did a little bit of research. There's this book, it's almost like the Canadian equivalent of the Millionaire Next Door type thing. It's called The Wealthy Barber. And it's the same themes that you have in other books that are famous globally, or at least in the US. Anyways, the premise is this barber who, looks like your average Joe, neighbor, socks his money away as a barber, and he's the millionaire basically next door. You just don't know it. And in that book, they talked about avoiding, and I'm sure it's the case in other parts of North America, the US, a lot of Canadians initially will go into a bank, a local branch of one of the big five banks here in Canada, and speak to an advisor who is not a financial advisor, they're a salesperson, and buy mutual funds with high MERs and maybe front end fees, trailer fees. It's just a bad product that actually makes money for the bank and ensures you lose money. So I knew enough not to do that. So I started investing in index funds because, I understand that I'm not the smartest person in the room, and I'd rather track the market and at least capture what the market's producing. Fast forward, I would say into my 30s, give or take. And I held Canadian funds that track the TSX, the Toronto Stock Exchange. And in Canada, unlike the US, for sure, Canada is a small market. Basically, you've got some financials, some utilities, oil and gas that primarily make up the TSX. And so it's very easy in Canada to go out and duplicate the Toronto Stock Exchange just by buying, some financials, some life insurance companies, a pipeline, some utilities. Basically, in a nutshell, you've recreated the TSX. And of course, your return is higher if you own the individual stock versus, the dividends you're getting paid, or the distribution, at least from the fund, the dividends are higher if you own the stock directly. And it's easy to own the stock directly as a Canadian because you can duplicate the TSX very easily. The market isn't that big in Canada. Mm-hmm. Now, the US, on the other hand, is huge. And trying to duplicate the US S&P 500, for example, is more challenging. Probably not impossible, but more challenging. Definitely more challenging as a Canadian, given the exchange rate. I lose about a quarter to 35 cents on the dollar, depending on where the exchange is.
Wow.
And so that's a little harsh. But anyways, I just noticed that I could make more money and duplicate the Canadian Toronto Stock Exchange very easily by owning the stocks directly. And so I did. and I moved out of the index funds that were tracking, the Toronto Stock Exchange, but still hold index funds that track, VTI, for example. I own the Vanguard Total Stock Market ETF for the US. I own also like XAW, which is ex Canada, which means it doesn't own Canada, but owns, don't quote me on it, but about 60% US and then globally as well in other parts of the world, because it's hard for Canadians or Americans to diversify beyond their country without owning an index fund.
Mm-hmm.
So that's sort of where I stand. So I've turned into what I had mentioned prior is a hybrid investor, a mix of individual stocks, primarily in Canada, my home country, and then index funds to own the US market, but also globally as well.
So how do you, I'm assuming you have the determination when you're looking in the United States stock market that you are under the assumption that the stock that you're going to buy is going to, one, give you better performance than anything you could buy on the Toronto Stock Exchange, but also make up for the loss that you're going to get because of the exchange rate, correct?
Yeah, I mean, that's one way of looking at it. I'm not sure I go that deep, to be honest. The way I generally pick stocks is I look at the top 10. I mean, this is the easy way to do it. And I try to, there's this acronym called KISS, keep it simple, stupid. They used to say, now they've made it nicer to keep it super simple.
Yeah.
When I was a kid, it was keep it stupid, simple, stupid.
Yeah.
And so I try to keep it simple. I'm not looking at charts every day. I see those charts and my eyes glaze over. So I just generally pick the top 10 stocks in an index fund if I want to own the individual stock. And so in Canada, you look at the top 10 of a fund that's tracking the TSX, you're going to have the big banks, you're going to have, some pipelines in there, so oil and gas, et cetera. So you can just go, cherry pick one of those or two of those. I happen to own all the banks, for example, in Canada, because they're such great dividend performers. They've been paying dividends, since the 1800s, consistently, year after year. I don't think they miss a beat in hundreds of years, or at least 100 years. So I own them. And yeah, that's the way I've approached it, in a sort of keep it simple strategy. I'm not here spending hours. Some folks are great for it. I look at some of their stuff online, but I'm not one of these investors that's, and rightly or wrongly, people can criticize it, I guess, but I'm not here spending hours a day analyzing charts. I'm just not doing it.
Yeah. I mean, on my channel, I always say like dividends done difference, kind of like my tagline. And it's just like you're saying, to each their own. If you want to, or have the knowledge to go as deep as some of these people go, more power to you. Mine is literally like 3 simple metrics. Does it outperform the S&P 500 over the past 10 years? Dividend streak of at least 5 years, and have a dividend growth rate above 10% over the last 3, 5, and 10 years. That's it. And then I might throw like a payout ratio in there too, because I want them to raise the dividends by so much. They need to have a lower payout ratio to do so. So just stuff like that. I mean, there's other things I might consider. But for the most part, like I've been keeping pace with the market, just looking at those things. So,
Yeah.
I don't know. It doesn't need to be as complicated as everybody makes it. That's all I gotta say.
I agree. And I tell either younger people, so my, nieces or younger friends, or frankly, even friends my age, that, they get stuck in analysis paralysis because can get bogged down and all that stuff you said. I'm quite familiar with it. I understand it. And I do look at that on a maybe more of a surface level than you might, Troy, in the work that you do and your analysis you do. But I tell my friends or younger people, like, you can get bogged down in all of that, or you can just go and buy VTI.
Yeah.
Like, and they get bogged down. Well, I don't know how to do it. I'm like, get a robo advisor. Like, just, give them your money. You probably get it at your age or younger age. It's like at least a 90-10 or an 80-20, 80 equity, 90 equity, maybe 10 or 20 bond. If you're going to have any bond exposure, you could probably be 100% equity if you're in your 20s, and just buy VTI and stick, donate as much money, or contribute as much money as you can on a daily, weekly, monthly basis. And let the robo advisor, if you really are trying to dumb this down, let the robo advisor stick it in the fund for you. You have one obligation: set up that reoccurring payment, or do it manually if you can be trusted to do it, and leave it and keep doing that for 20 or 30 years if you really want to make it simple, but just do it.
Yeah.
Too many people get stuck in not doing it, and then they find themselves, they get married, they have kids, they've got a job, they come home, they just want to watch some TV and go to bed. And fast forward, you're my age, and you're thinking, geez, I don't like work as much as I did in my 20s, and I want to retire. Me, I could retire probably, but I've got friends that I know are going to be working to 65, 75, 85 because they haven't, even done something as simple as sticking, as much money as they can into something as simple as VTI and letting it ride.
Yeah. Yeah. I mean, that's my, like, again, not, professional advice or whatever, but like one of my suggestions, if I were in the situation, I'm like, hey, if you don't like the stock market, but like most people have an idea of what the stock market is, but a lot of people don't know how the stock market is, if that makes sense. So my suggestion is always like VTI or VOO, just like a broad-based index fund. Just do that. And then worst case scenario, you're putting reoccurring money into that $50, $100 a paycheck, whatever you can afford. Put that in there. And if you never get an interest in it, you're going to have money at the end when you need it. And if you do get an interest in it, which is how I kind of got started, is you start like VOO pays a dividend. So like you put your money in VOO, and then all of a sudden, like a year, 2 years, 5 years from now, you're like, oh, that's weird. Like, what did I get $68 as a dividend from VOO for? Then you can start looking into it, and you already have a good base, and then you can build on it if you want to. Again, if you don't want to do that, just keep doing what you're doing and it'll work out eventually. So
I agree. That's sort of the way I did. I started with index funds, a couple of funds. I don't remember them now, but a couple of funds domestically, of course, and US and internationally, and did nothing except invest what I could at the time, which was a lower amount of money than I can invest now because my pay was a lot lower than it is now. And as I was doing that, and I gained a little bit more confidence, and then frankly interest, and I started to more in my 30s, I'd say mid to late 30s and 40s, started to really dig into it. But I'd been investing all along. I just didn't have well, I'm going to say I didn't have the time. I probably had the time, but just didn't have the interest in it that I have now. And now I really, I created my online persona as Dividend Daddy, and I have the blog, and I'm sort of into it, partly because too, as I branch into a sort of work optional early retirement phase that's coming. This gives me something to do as well that keeps the mind busy, and I gotta have things to do to retire to rather than retire from, if you know what I mean.
Yeah, that's a really good way to put it too. Okay, so next question for you is like, whether it's investing in general or dividends investing specifically, has there been any big mistakes that you've made? And more importantly than the mistake, what lesson did you learn from that mistake?
I think we've all made that mistake where you get that hot tip from a family member or friend that isn't so hot. So I think I still own it actually. Now that I look at my portfolio, because I don't, I want to sell. I want to dump this stock so bad, but I don't want to lose.
You're waiting for it to go up 10%.
Yeah, it did, but it went up in a brief moment, and I wasn't paying attention, and it dipped back down. I was like, damn it, that was my
that was my chance. Yeah.
It's drdr.to, so it's like a medical. They own, I think, hospitals and stuff in the U.S., but it's sold on the TSX. Anyways, it paid a really nice dividend. And I got a tip from a friend in the financial industry, say, you got to buy this stock. It's like, Daddy, you're going to love the dividends. And I did for a while until they cut their dividend, and it's a shell of its former self. Anyways, I should never have invested in this because it didn't meet the look. I'm not religious about this, but there's just a lot of people in this space, at least in Canada, and I'm not responsible for naming it this, so I don't take credit for it, but they invest in what's known as, or what they call or term, stocks with like moats around it. So if you think of a castle, a castle has that, like, in the old fairy tales, it has like that water portion around the castle.
It's got crocodiles and stuff in it, so you don't go.
Yeah, it's hard to get over if you're attacking the castle, right?
Yeah.
And trying to like do whatever you're doing. So those stocks in Canada tend to be the banks, because good luck getting a charter to open another bank in this country. Like, you're just not going to get it. So there's a few banks, and they've been paying dividends since the 1800s. You're not going to open a bank in this country tomorrow. Good luck. And then there's pipelines. Well, good luck getting another pipeline built in this political environment, but particularly in Canada, where it's almost impossible. So invest in one or two of the pipelines here, and because they're not building anymore.
Mm-hmm.
Railways. There's two
Yep.
railways in this country. Pick one. They're not building any more rails. So as you get the point, there's a moat around these things. So I don't even know how we got on this subject now, but I invest in those because they've got a moat around it. But how we dovetailed into that, I can't.
It basically, you were just answering the question of like the mistake you made and the lesson you learned from it. So you trusted your friend with that stock just because of the dividend. You sound like the cool thing about me asking this question is no matter if I've asked somebody that's just been investing for a year, 20 years, 60 years, whatever they're investing for, it always boils down to they bought something because of somebody else or because of the yield, which is what yours was a combination of those two things. You had a friend in the financial industry tell you about a stock that had a good yield, and like you didn't have your own convictions on it, which I always tell people on the channel, like no matter if you find a stock on my channel that I suggest, I always recommend doing your own due diligence, because if you buy a stock that you didn't convince yourself that you wanted that stock, the moment it goes down 3%, you want to sell it. Because like you didn't convince yourself of all the reasons that you want that stock in the first place.
And it wasn't, there was no moat around it.
Yeah. Yep.
And so I should never have invested in it, but I did. And look, worse things happen in life than that. But I will eventually, I'd love to dump the whole thing, but I don't want to lose what I'm going to lose on it. So I'm holding it because I haven't lost anything if I haven't sold.
Yeah, I like that. Yeah, I've seen that. There was a series on Netflix I watched where the guy bought, I think it was like AMC or GameStop, and he went, up a lot on it, and then it went down like 60% or something. And he told the guy in the show, he was like, yeah, I'm waiting until it goes back up to my cost basis to sell. And he goes, do you think it's ever going to go back to your cost basis? He goes, well, maybe. And I'm like, all right, so you're just going to hold this forever. That's what's going to happen. But
yeah, the analysts on that Dr.to stock say it's they've got the projections being higher than what it sells for currently. So I am holding, but I am inclined on some days just to go in there and just sell the thing. But I am holding for now.
I mean, at the end of the day, like you can assume the money's lost, but like you said, the money's not lost until you actually sell it. But I mean, you're just basically trying to say, do I want to lose $100 or $95? So,
well, it's gonna be a little bit more than that. But,
yeah.
Couple thousand anyways, but it's not
right.
in the grand scheme of things, it's not a lot of money. I just I don't like losing, but whatever.
I can relate to that. Okay, so you mentioned that you are close to retirement, you could retire, but I still want to ask you, do you have any like really short-term goals, and what do those look like, and then what do your long-term goals look like being so close to retirement?
It's a good question. I am figuring all of this out on the fly because it's new. Mm-hmm. So the big item for me is control. Control of my life, control of my schedule, control of what I'm doing when I want to do it, rather than being told I need to be in the office on Monday. I've got to be in the office Monday. That's a instruction from my boss, mm-hmm. To be in the office, and generally I'm there, give or take, from 9 to 5. And look, I enjoy the work, but I want that control back. That I've got whatever the statutory 4-5 weeks vacation that I've got a year, and yes, I take them all. Would I like to take more? Absolutely, but I'm not in control. They're paying me a paycheck. It's a nice one. It's a nice paycheck. But so the big picture is I'd like that control of my life at this stage, and I can afford to have a bit of that control. So I'd like it. And then in terms of things like goals, slow travel is a goal of mine, because when you're working a 9 to 5 job, you get the Americans maybe get a little bit less vacation generally than Canadians, and we get as Canadians less than what Europeans will get. But we're sort of in that middle, caught between Europe and America in terms of those sorts of things. And I'm going to Europe this fall, and I'm going for 2 weeks. It's a nice amount of time, but it's a bit rushed, because I've got to get there, and I can't just sit around and take it slow, because I'm going to run out of time and have to catch that flight back to Canada to go back to work. Mm-hmm. So a goal of mine is to be able to just slow travel and spend more time doing that. I'm Canadian, and I don't like winter, and it
Well,
can be cold
that's
here.
yeah.
So I'd like to escape down south. I've got a place down in Mexico, so I'd like to spend more time down there because it's warmer than it is here in the winter. So I like that aspect of it. So those things, definitely more travels on the horizon. My parents are getting older; they're pretty young by all things considered, given my age. But I'd like to spend more time with them because I think the data is you've spent like 95% of the time you're going to spend with your parents from age 1 to 18 or
Mhm.
0 to 18. After that, you've spent majority like 98% or whatever it is of the time you're going to spend with your parents once you've hit 18 years of age. So I've still got both my parents, and I'd like to spend more time with them.
Mhm.
That's important to me. So again, I need the time and control to be able to do those things, and I don't fully have that yet. So those are some of the, I guess, high level goals. I do focus a lot on fitness and health, and I'm incorporating a lot more of that into my life. I've been doing that for a long time, but I think I could incorporate even more if I had more time to devote to those things. I do gym classes. I did one this morning. I'll do one tomorrow. But the getting to the gym for the gym class at 5 p.m. from the office, I can't quite swing it.
Mhm.
Whereas that noon class looks really good, or the 1 o'clock class or the 11 a.m. class looks really good, but I can't swing it because I'm at the office.
Mhm.
I'm on Zoom or whatever I'm doing in a meeting. So those are some high level things that I'm looking forward to.
Yeah, I mean it's all about like I mean you talk about the FIRE, financial independence, retire early. I mean the retire early part is I don't know what retirement age is in Canada, but here it's typically considered to be like 65.
That's about
Um,
the
yeah, so I mean anything before that is retiring early, and then really the big part of it is the first two letters, the financial independence, and it's not to say that you'll never work again, but it's the option to not do. I mean, you said that you like your job, but there could be something else that you enjoy even more. Maybe that's volunteering, or maybe like for me being into fitness, I would think like if I can retire by 50 like my goal is, like that's like the middle case scenario for my goal. Like I could be a personal trainer between the hours of 10 a.m. and 2 p.m. on Monday, Wednesday, and Friday if I want. I don't care what they're paying me. I just want to go and help people be physically active and physically fit. And the pay doesn't matter because I'm already financially independent on my own, and this is just a nice little fun thing that I'm doing. Or if I want to donate my time somewhere else, or spend it with the family or friends or whatever it might be. So that's really cool. It's a really cool thing with dividend investing specifically because you are getting not only do you get to invest in holdings that accumulate capital appreciation over time, but you don't have to sell those to get that money. You keep that money and they give you money while you're holding, which is great. So
Yeah, I know there's a whole debate in the community about total return, and generally, I think the science or the math or the data suggests that you're better off on a total return basis in the sense of selling stock and buying stock that perform or outperform the market. And sometimes dividend stocks, the best dividend stocks do both.
mhm.
They pay you and they outperform. But I think in a totality, the dividend approach actually is probably mathematically and data wise the inferior approach. You're better to buy certain stocks and sell them off and use that as income. However, what helps you sleep at night, is a different story. And for me, I kind of like the idea of collecting dividends because I'm not selling principal, particularly in the first 10 or so years of an early retirement scenario where your risk is the sequence of return risk. And for me, again, I never excelled at math in school. I'm not a math guy. I find all of the discussions around. Look, I read them all. I listen to them. I can comprehend it. But I find the yield shield, the cash buckets, all these other strategies, like they make my mind hurt. Um,
Yeah.
and like for me, the easiest thing is often, I just prefer, I sort of default to what's the easiest, and the easiest to me that I can, you know, suss out is, dividends. and not don't go crazy on yield because you often end up getting burned.
Mhm.
But I collect right now a pretty healthy chunk of dividends. I reinvest them now, but that will be part of my income in early retirement. I do plan on working, being work optional, so taking on a contract, but having the flexibility, particularly with modern means, the internet and Zoom and all that, of not having to be tethered to my home city,
Mhm.
but being able to, if I'm in Europe I'm making it up, I'm in a month in Copenhagen. Yeah, there's a time difference, but I can jump on a Zoom and do some work that way over email as well, but not be tethered to my home country and collect dividends. I've got a bit of real estate income coming in, and any work optional stuff that comes in would be gravy on top of that. And I'm also, while I'm away, I'm considering, although it gives me a little bit of jitters, is Airbnb being my principal home here
Mhm.
while I'm away. Because if I'm away for, in a year, calendar year, 6 months, the asset here of my home sits idle. So I am preparing my home for a potential Airbnb scenario where I'd have a property manager managing it. And yeah, they take a cut, but this is gravy, remember?
Yeah.
So it's not money, it's just gravy. It is money, but it's gravy. And maybe renting it out short term on a short term basis while I'm slow traveling and in early retirement work optional phase. And when I want my home in back in Canada, I'll block the calendar off and fly back home and have it here. And maybe, who knows, maybe in a couple of years I'll sell it and pick up one of those. I think it's a D7 visa, for passive income visa, they call it in Spain or Portugal, and try to eventually get an EU passport and get out of Canada.
Yeah, that's really. I like hearing all those goals and stuff because like one thing as you were talking that made me think is before COVID, most people worked in office, and everybody was tied to their desk. Like you're saying, you have a place you have to be certain times, certain days, and then COVID. A lot of people got to experience work from home for the first time where they had more flexibility. It was almost what you're talking about, like the work from anywhere, because when you're working from home and everybody's working from home, it doesn't necessarily matter if you answer the Zoom call in your bedroom or in your living room or even at the park or wherever. As long as, obviously, if you're in a meeting or something, you have to have a good environment, not to be too loud or whatever. But it's still the same point of like you can kind of be anywhere. And a lot of people that did work from home, they really enjoyed that. And dividend investing allows you to do like it builds your nest egg to the point where you can do that, or even the supercharged version of just you're getting a paycheck to not work from anywhere. Like literally, like if you want to really do the full fire movement, you can retire, you don't have to work, you get paid still from these companies that you hold, and you can literally be anywhere and do anything you want whenever you want. That's kind of how that looks, and it's just kind of cool to think about it that way where everybody really enjoyed the work from home. Now imagine that supercharged where you're getting paid to not work and you can do it from
Yeah,
anywhere. So
my favorite part of Saturday is waking up, checking my dividends, and seeing I got paid while I was sleeping, or whatever I was doing at the gym, or getting paid to frankly do nothing is great. Now people could argue, like, I know there's a whole debate in the Twitter community about, are you really being paid, and is it better to collect a dividend or have the company reinvest that money? I know there's a legitimate debate there, and they're probably right, actually, when it comes down to the data. But again, what helps you sleep at night? I paid off my mortgage at a time when interest rates were not what they are today. They were much lower. But was that the best and smartest decision? I think the context in Canada is probably a little bit different because we don't get 30-year mortgages in
mhm.
Canada. You get 5 years and then you have to renew every 5 years. So, that's not the same reality that the US has, where you can lock in a low rate for 30 years. I think there's a different case to be made, but here it's 5 years. So I made the decision when rates were low and I had a low interest rate on my mortgage on my principal residence to sell it. Why? Because it helps me sleep at night. And frankly, I enjoyed not having that chunk of money come out of my bank account on a monthly basis. And I had that money now to invest in dividend paying stocks. And that kind of excited me to have that surplus cash that I didn't have.
Yeah. Yeah. I mean, at the end of the day, investing or managing money in general is all opportunity cost. It's not that anything that one person does versus what the other person does is right or wrong. It's just, hey, this made you $100,000. This could have made you $120,000. Like either way, you still made at least $100,000, so you're good. But it's really opportunity cost. So I mean, that's the gray area, which is a huge gray area. Pretty much the whole thing about investing is the gray area of like opportunity cost. It's this or that, or that, or that, or that. So it really, really expands onto that. Like you said, peace of mind also comes with a price too. So
Yeah, I find there are, and I'm not one of these people. Again, I'm not pointing fingers, but there's people that want to optimize for everything, and I just find it exhausting. So, am I being the most tax efficient? Am I being the most optimal investor? Probably no on every one of these measurements. But at the end of the day, if it's a difference of $100,000, I really care. If it's a difference of a couple $100 or even a couple $1,000 for my sanity and my time that I could devote to riding my bicycle rather than worrying about, am I being the most optimal to save $100 here or there? At the end of the day, I don't care.
Yeah.
Now, if we're talking $100,000, I definitely care.
Yeah.
We're talking 10,000, 20,000, I care. But if it's a couple dollars on the margin, I'd rather be on my bicycle.
Yeah.
To be honest.
Yeah. And that's, everybody needs to find that sweet spot for them too. Like you're saying, like there's a certain spot there where it turns from like, it's not worth it. It doesn't need to take up my headspace. I'd rather do this. And then at a certain point it switches over. It is worth my time. It is worth my headspace. I have to figure this out. So,
sure. And then I can hire somebody that knows a heck of a lot
yeah,
more.
Yeah. And then it doesn't need to take up your headspace anyway. So, okay. So do you have, since you've been investing for the better part of 20 years, I'm sure you have some stocks that you owned and you regret selling, and then stocks that you bought and you can brag about them. So do you have any of those to share with us?
Good question. My first stock I bought was CN Rail, and I remember it was my first like individual stock I had bought myself, and this would have been, I'm going to say, well, it was definitely early on. So I was in my early 20s, and I checked, was checking it in the newspaper, each day to see you check the newspaper to see if the stocks went up or down. Stuff wasn't really online then, so you check the newspaper the next day. Then they have all the little symbols on the thing, and you read and find your symbol. And I watch, it had gone down. And I got the newspaper the next day and it had gone down again, and I ended up selling it. What a stupid move. But I didn't know what I was doing. And I own CN now, but I had actually, whatever I bought, it probably wasn't a lot, and sold it right away because, oh my God, the world's ending, it's going down. I didn't understand all these things back then. But that, you're not talking about a lot of money, so whatever. And it was a learning exercise, I guess. In terms of like stocks that like shot through the roof, I wish I could tell you I had Apple when it was low, or Shopify when it was low and sold at the top. I don't really, or Tesla when it was low, or Amazon. I don't have any of those. I do remember I was in university in the 90s, and in Ontario and Canada, there's this program that for student loans, although tuition was so low at the time. But there's a bunch of friends I know that were gaming the system and collecting government tuition support. They call it OSAP here, on Ontario student. I don't know. Anyways, they give you money. The government gives you a loan, basically interest-free loan to go to school to pay tuition, and you pay it back after, but it's interest-free while you're in school. And I had it because I actually needed a little bit of it to pay tuition, although it was quite low at the time. Other friends who had the money, parental or otherwise, applied, got it, but were investing in the dot-com era of when all the, before the bust. This would have been like, I don't know, like 96, 97, as the run up to the dot-com bubble that burst in the late 90s. And boy, they were dumping money into pets.com and all this stuff. And Amazon at the time. I'm not sure how many of them how much money they lost when the bubble burst, or, if it was Amazon, if they hung on to it long enough to see, it go to where it is today. I don't have any of those stories because frankly, I didn't have the money to invest back then. And investing was harder back then.
Mhm.
It wasn't like clicking a few buttons on an app. It was calling and faxing and mailing forms. So it was
When
more
you had fees
challenging.
for every transaction you did too.
High fees for
Yeah.
every, like, $5 is a great fee if you're paying anything today. But you're looking back then, $30 a trade. So high fees. I didn't have the money to invest, but I had friends borrowing government money and dumping it into the dot-com era before the bubble burst. I don't have any stories like that. Sorry. I
No,
wish I
I mean,
did.
hey, that's good for you. I'm glad you don't. That's the thing. So, I mean, do you still are you still in touch with those friends? Did you ever ask them about it?
No, good question. I do see them occasionally, but I haven't asked them. But I have one friend I remember. He was really aggressive, and getting money, doing whatever he could to throw it into, like, the pets.com of the world. And these are all things that went belly up, I think. And so no, I don't know, but I next time I see him, I'm definitely gonna ask him
Yeah,
now.
it's probably a sore sore subject for them. So you got to be careful.
He
Hey,
had to
remember
pay
when you
those
lost
loans
all that
back
money?
too. He had to pay them back.
Yeah, yeah.
And look, I didn't have the money to do it. I had to use that money for the purpose it was intended for.
Yeah. Hey, well, that's good on you because I mean, it doesn't sound like it panned out well for them. So
No, I did get caught up a little bit early days. I guess now that I think about it, so I was in the office, and there was a couple of younger folks, I'd say in their 20s, and I was obviously, a generation removed from them or two, and they were talking about crypto in its early days, not Bitcoin early days, but like they were talking about the, ant shares being the sort of next big the Bitcoin of China, basically, was they were talking about. And they were on all these like server message boards that were in Cantonese and Mandarin. They're saying you got to buy these ant shares and shape shift them into this other cryptocurrency. Anyways, I got a little burned on that stuff. It seemed like a gold rush at the time, which is never a good thing. But look, you're human. I got wrapped up into a bit of I probably and then Quadriga is where I was storing the money. I wasn't even storing on a cold wallet back then. And the founder of Quadriga was found dead a couple of years ago, I think in India or something, and he took all the passwords with him. So I might have lost in the crypto space on that sort of, a couple $1,000s. Now, again, not life changing money. Like, I'd like my $2,000 or $3,000 back, please,
yeah,
Mister Crypto.
yeah,
But
yeah.
I'm not going to see it back. Whatever. Look, it's a couple $1,000s. It's not going to make or break me. But I did get caught up a little bit in that sort of. This would have been. Let me think what year this would have been. This would have been around 2013, 2014. Was that no, sorry, excuse me. That would have been around 20. When did I start that job? Oh yeah, I started in 2014. So I would say this was maybe around 2016, 2017. I kind of got into this crypto stuff, and yeah, I got burnt a bit.
Yeah. I mean, at the end of the day, like the a cool way to think about it is like like you walk into this dividend investing store or this investing store in general, and there's stuff on the shelves, and each of those are lessons, and each lesson is going to cost you some amount of time or money or both. And I mean, that was your lesson that you learned about the crypto and the hype and all kinds of stuff, and it cost you $2,000-$3,000, which obviously is a very expensive item. But if it was 2 or 3 thousand, the most important thing isn't necessarily the cost or the time spent. It's the fact that you spent that time and that money and learned the lesson. Because a lot of people will do this thing and they just think, oh, it was that one thing that was the problem, not the idea I had. I'm going to do this over here, and then they lose the same time and the same money, or more time or more money on a different thing that's the same thing. If that makes sense.
No, totally. Still own a little bit of crypto, and I hold it through a legitimate government regulated entity, and so it's all above board. Unlike the early Wild West days of crypto,
Yeah.
where I lost some money. I own like Ethereum and Bitcoin, but a couple $1,000s. And I figure either that's going to the moon, I'm going to own a Lambo, or I'm going to lose it all either way.
Yeah.
So
Yeah.
it's a Lambo, or I'm at the dollar store.
Yeah.
One or the
I mean, hey, those are the options. So there's no in between. But yeah, I mean, I think it was the beginning of this year or maybe the beginning of last year. One of my portfolio goals was to try to get 1% of my portfolio in crypto. The hard part for me was just like at the end, I own Apple and Microsoft and like obviously other stocks in my portfolio. And when I had, let's just say $100 to put in, I was like, man, do I buy Bitcoin or Apple? And that was a
Yeah,
very hard question for me to answer Bitcoin to. So I just kept buying Apple and I never bought more crypto. So
I think you made the right
yeah,
call.
yeah. So
I would stick my money in Microsoft or Apple before I bought
yeah,
any more Bitcoin. I'm leaving my Bitcoin that I own. I'm not touching it because I figure who knows in 20 years maybe there's another rush on it, and I've got some exposure to it, but I'm comfortable with the exposure I have. I'm not adding to it anymore.
yeah, yeah. My idea was just like, okay, if it's 1% and it blows up and turns into 50% of my portfolio, I can sell some gains. Or if I lose it, I lost 1% of my portfolio. So
Yeah, you lose 1% or you'd be a billionaire.
yeah, yeah. So those are your options. But I mean, at the end of the day, like I said, I don't think I've bought in crypto in 18 months, 24 months, something like that. I just can't like Visa or Bitcoin. Like I'm gonna buy Visa, of course. But anyway, okay. So next question for you is, what role does like the dividend milestones and achievements that you've gotten so far, like what role do those play in keeping you motivated in the dividend game? Because it is a long game. Like you've been doing it for 20 years. It's not like a, snap your fingers and you're rich tomorrow kind of thing.
Yeah, you know what I find the most motivating still is, and I'm relatively new to some of these tools that track your projected annual dividend income, your PADI,
Mm-hmm.
to use the acronym. So there's tools, I don't know what they are in America, probably, Personal Capital, which is now something else, I think, and other tools that we don't have here. We use different tools in Canada. But anyways, it tracks my portfolio and tells me what my projected dividend income is going to be for the calendar year. And so every time I buy an index fund or a dividend paying stock, it recalculates.
Mm-hmm.
Okay, I just bought yesterday. I bought I think it was 25 shares of Enbridge, which is a pipeline company with a lot of U.S. exposure too, but is a Canadian company. And so I go into Wealthica, which is like Personal Capital, whatever they call it now in the US. And you refresh it, and it recalculates my projected annual dividend income based on those 25 new shares of a stock that pays, I think it's 89 cents a quarter in terms of dividends. So
Mm-hmm.
I see the number go up, basically, is what I'm trying to say. And my goal this calendar year, 2023, was $75,000 in dividend income. And I'm like, don't quote me on it. I checked this morning, but I think I'm about $400 Canadian away from that goal. And basically, when I go in Monday, and if I either have some dividends to reinvest or I put some new capital in, so I'm always doing, a mix of both or one or the other. And because I'm buying every week,
Mm-hmm.
frankly. And I see that number go up on a daily, weekly, monthly basis. I find that extremely motivating.
Yep.
So even if the numbers were small, even rewind the clock back, to go from, I imagine, again, they didn't have tools like this. They didn't have the internet when I started, really. So to have tools like that, where you could see, well, gee, I'm collecting $25 of dividend income this month, but next month it's 30.
Mm-hmm.
Wow, 50, and now it's 100, and now it's 1,000 a year, and now it's 5,000 a year. And you can see that chart is up and to the right. That's extremely motivating, even for me still. Look, I'm not the richest dividend guy out there, but I have a healthy amount of dividends.
Mm-hmm.
That's extremely motivating to me to see it in real time.
Yeah, it is really. And then the coolest thing, in my opinion, because I do the same thing. I have a spreadsheet that tracks all that stuff for me. Well, I mean, I update the spreadsheet and then it tells me. But the cooler thing is I own Illinois Toolworks, which is a dividend king here. It's been paying and growing for like 61 years or something in a row. They just gave me a 6.9% dividend increase. That's
Love it.
even cooler because I didn't add any money and I didn't reinvest any money, but I just got a 6.9% raise on my projected annual, or on the projected annual income from that stock. And
Sure.
I didn't even do anything. Like that's
Yeah.
even better.
Oh yeah, I love both of those.
Yeah.
And again, when they do that, it recalculates,
Yeah.
and suddenly your projected annual dividend income is increased by, I own Verizon as a U.S. stock and just had another dividend raise, small. I think it was 1 point something, if I
Mhm.
remember, or whatever it was. So look, that's more money that I didn't have. from the small amount of Verizon stock I own. So giddy up. I'll take it.
Well,
It's a pay raise is a pay raise, right?
yeah, there's so many people that'll scoff at like I said, my goal, at least for now at this point in my journey, I like to go for those double digit raises. But at the end of the day, like if you this is at the day job that you go to, you spend 9 to 5 Monday through Friday. If you were to walk in on Monday and your boss is like, "Hey, we're gonna call you into the office. We're gonna give you a 1.9% raise," you're not gonna be like, "Oh, boo hoo, woe is me." Like you're gonna be like, "Heck yeah, that's cool." And that's a job you're working at, spending time and money with, or to like, you're spending your time there. This is a job where you don't even work at Verizon, and the boss was just like, "Hey, we're going to give you a 1.9% raise. Are you okay with that?"
Yeah.
And like, there's, like I said, there's certain people that are just like, "Oh, boohoo, it's a little raise." Like I said, I prefer giant raises. I think everybody prefers giant raises, but it's also one of those things. Like, I'm not going to complain at it. Like, that's not that. Why would you do that? So,
Yeah, I also love special dividends too. I know
yeah.
they're not reoccurring, they're one time, but boy, I remember sometimes you get like $1.50 a share special dividend, and
Mhm.
like, that's exciting because that's money. Yeah, it's not going to happen again next quarter because it was special, but those are great too. Like, I love to see those. Those are exciting.
I just bought my
I don't
first
know the
company
time.
that like is like not really known for it, but they do them, which is Costco. And I think the last time they did it, they did like something crazy. Like I think it was like $5 or $7 per share,
Love it.
which is ridiculous. The only thing I'm thinking about, and like this is another woe is me kind of problem, is like, what will that do to like the next December? So say they do it in December, and then the next December I still stay on my thing, but they don't do that raise, and then it looks like I had like a reduction from December to December because I had like a
Sure.
weird thing happen. Like that would be annoying to me, but
I'll still take the money.
yeah, I guess it's a good problem to have. So
I had someone just on that point. I had someone rail on Twitter at me. I posted I got some X amount of dividends from wherever I was getting them from. And their point was, and I was a bit, what's the word? I didn't choose violence, but I was a bit aggressive on the reply because basically their message to me was, well, enjoy paying taxes on that. And I'm like, well, enjoy being poor. Like I'll gladly look. I don't like to pay taxes. I pay what I'm legally obligated to pay. It's apparently or proposally for the benefit of society we live in. Fine, it's a necessary evil. You got to pay them. But I'd rather pay taxes on the income I collect. Like that's it's a good thing. Would you prefer not to collect the money and not pay taxes? No, thank you. I don't want to stay poor. So I've had that kind of retort, and I'm like, okay, whatever. Like, keep doing what you're doing, buddy. And like, I'm going to keep doing what I'm doing, and we'll see who's enjoying life 20 years from now.
yeah,
So
it's one I've seen that with people talk about like people that don't do dividend investing, and they'll tell me they're like, "Oh yeah, but you still have to pay taxes on that." I'm like, "Well, if you want to be technical, up to a certain amount, I don't pay any taxes on my dividends as long as
fair
they're
enough.
qualified." And also, like I moved my savings account, like my emergency fund, from my bank to Fidelity because SPAXX with Fidelity is giving like currently I think it's 4.95% interest. Um, and somebody said the same exact comment to me. They were like, "Oh, make sure you're watching out for the interest that you're going to have to pay." I'm like, "Yeah, but like if I'm getting $100 that I wasn't going to get, I can give whatever it is $10 away. I still have 90 more dollars than I would have had." Like I don't understand where that thought comes from.
Yeah, it's not logical and it makes no sense, but I get it a lot. And I'm just like, look, okay, whatever. Clearly, they don't understand the fact that you're pocketing more. Because if look, the tax on interest or the tax on the interest was 100%, then you're no further ahead or you're no further
Yeah,
behind. And that would be idiotic. And he would have a point or she would have a point, but it's not.
yeah.
And I'm happy to collect the difference. Thank you.
Yeah, I mean, I could give you the money that I just paid in taxes, and I'd still have more money than you. So I don't know, I don't know what your point is, but yeah. Okay, so next question. You're probably a really good person to answer this. So you said that you probably could retire now, but you probably have like another 1 or 2 years to go at it. So how or when do you know, or will you know when enough is actually enough? And the reason I ask this is because in dividend investing, especially since you like you appreciate one of the metrics I do, which is that projected annual income, and you can also project it out like over some years based on capital appreciation and the dividend growth rates and whatever. Um, you constantly see that little arch up into the right where it gets bigger and bigger and bigger the longer you leave it alone. So like, is it going to be hard for you to like step back and like actually start taking some money out of that, or have you like come to that like, is that okay with you now?
The struggle is real.
Yeah, yeah, yeah.
Um, it is a struggle. So I, based on the numbers you run, I'm pretty sure I could retire now based on what I'm spending versus what I take in from a variety of sources. What makes but I am a little bit, like, I'm a human being, so I'm a little bit nervous about. I would leave a very high paying job,
Mhm.
and it's as I'm getting older, mid 40s. I find, maybe I don't think it's unique to me. I talk to friends my age that have high paying jobs, and what they find generally is you work less and you're earning more money as you get older.
Mhm.
So I work less, and the pay is better. I don't know if that's just seems to be the way things work. So, I mean, of course, there's exceptions to the rule. If you're CEO of a company, you're probably working a ton of hours and your compensation way skyrockets beyond what mine would be. Fair enough. So, how much is enough? I struggle with this because I know one thing that is finite, and that is time.
Mhm.
We all are, the day we're born, we're marching a slow march towards death.
That's
Not to be dark. True, it's true. We all are.
Yeah.
So I'm conscious, and I think being in my mid 40s again, like they say 50 is middle age, but no, I don't think it is, because your life expectancy isn't 100. If it were, 50 would be middle age, but we round up to 50 and treat it as, oh, you're middle age at 50. No, I think middle age is more like 35 to 40. So I'm actually a senior, if you want to look at that way already, because I'm beyond middle age based on what life expectancy in Canada. I think we're a little bit, well, like most of the world is higher than the US. You got a very low life expectancy in the US, which is just tragic based on how wealthy the US is. But so ours is higher than the US and Canada. But still, middle age, I've surpassed middle age now, given the fact that I'm in my mid 40s. If you look at life expectancy, and it's not 100. So time is finite. So how much time do you have? Probably not enough at this stage. So given that I'm mid 40s, so I think about that a lot. I am in good health, knock on wood, and I've got a decent family tree that is really, grandparents, and I knew my great grandmother very well, and she lived into her 90s, and my grandparents, not all of them did, but a lot of them did, and my parents are healthy. So maybe I've got that going for me, but it's no guarantee. So I struggle with that. I think what's giving me more comfort as I I'm sort of doing that one more year syndrome right now,
Mhm.
and it is, frankly, I am doing it, but I'm being paid extremely well. Like it's a lot of money. I'm a one percenter for sure, and so that helps. That eases that makes it a little bit easier to go in the office. I'll be honest, but um, will I do this for the next 5 years? No, the money isn't the be all and end all. So what I think is going to help me make that transition is work optional. So I'll have my dividend income, whatever it is at that point when I pull the trigger. For me, spending the dividends and not the principal, again, psychologically, I think is going to make it easier for me, because I'm not selling stock.
Mhm.
My portfolio isn't declining. I'm selling the flowers that are blooming off of the stock.
Mhm.
So I'm not selling principal. I'm selling. So I think that's going to make me, because the one problem retirees have is spending money, because they've been so used to accumulating money for 20, 30, 40 years. Spending it is hard, but I think spending dividends for me psychologically will be easier. I'll have some rental income. I've got two properties that are investment properties that I do rent out currently that do bring in money. And then I'm thinking, as I mentioned, renting out my principal home while I'm not present, and being work optional, taking on, again, having the luxury of not having to work, but taking on maybe a contract, even on a success fee basis, where I might be spending a few hours a week and I may get no income. But if I'm successful in doing whatever I'm doing under that contract, the delta could be massive. We're talking like, anywhere between 100 to half $500,000 success fee for spending a few hours a week. You may get nothing, but that will keep me busy, and there could be some gravy there. Or I may take a contract on retainer for anywhere. I could probably do. I know I could do a contract for, on the low end, $6,000, on the high end to $15,000 a month for a couple hours here or there a month based on what I do. So I think all of that combined gives me the psychological assurance I need that the income is going to be there to cover my very low costs in terms of what I spend annually. I don't have kids or significant others, so that keeps the cost down. But so all of that, I think, is going to help me psychologically deal with the challenge I have, which is turning off the tap of a very high paycheck.
Yeah, I mean, I know it's something that I'm gonna be in the same boat you're in as far as like the one more year thing, just because I can look at it and be like, okay, I made, whatever it is, 70 grand this year in dividends, but if I wait one more year, I can be at 70, or I could be at 82, or whatever the numbers are. And it's just, I'm gonna have that same problem where it's just like, man, just stick it out one more year, it'll be an extra 12 grand. Next year it'll be 15 grand, then it'll be 18 grand or whatever it is. So,
I'm looking at it right now. Like this year, I went from this year, my goal was 75,000. I'll hit that. I'll surpass it, obviously, because what are we now? It's September, and I'm
yeah,
like,
you have 3 more months to get
yeah,
$400.
I'll blow by it based on the money I dump in, new capital plus the reinvestment. So I'm going to blow past 75. But I look at it. I went from this year. I went from 56,000 annually to 75.
Yeah.
So if I did another year, I could blow probably very close to 100,000 in dividend income. And well, if you do another year, I could be upwards of 100.
Yeah, there's my problem.
Like
Yeah.
I'm seeing the numbers. I know where they go, and the snowball only collects more snow,
Yeah.
right?
Yep.
So it's growing quicker. And so yeah, stick it out. But I think for me, look, I don't know because the future is unpredictable. But I do think if I rent out particularly if I rent out my principal home, plus I have I may sell one of my other properties and just dump that money either into some of the mortgage debt I have on the investment properties or into the stock market, or a mix of both. And if I pick up one contract, again, even one contract that I do for 6 months at even lowballing it, extremely being conservative, at $5,000 a month, 5 times, do it for 12 months, a couple hours a week, that's 60 grand. Plus the dividend income, plus my low rate of spending, which is anywhere between $30,000 to $50,000 a year. Yeah, I'm going to travel a little bit more, but I even travel cheap,
Mhm.
So I think I'm going to be okay in terms of cash flow. And I think I think I'll have excess cash and I'll still be investing
Yeah.
in retirement, or quote unquote early retirement. I think I'm still going to be investing.
Yeah.
So that gives me a little bit of mental comfort.
Well,
It's a
that's
very
the
long
thing.
answer to your question.
Yeah, no, that's the thing that I've gotten from a couple interviews too, is like when I do, so like I said, my goal is 50. I'd love before that, but like 50 is the hard goal I'm setting. Like once I hit 50, like on the day I turn 50 or whatever that looks like, it's not like I stop investing at that point. Like especially if my goal is to get to the point where whatever my current expenses are, or the wife and I's current expenses are, plus 10%, that's the goal. That expenses is already including the money that I'm planning to invest every month. So like I can, in theory, I already have 10% more than I need, and I'm still investing at the same rate I was already investing before I retired. So I can still build my portfolio at the same rate. So like it's kind of the best of both worlds, where you don't necessarily need to you don't necessarily need to worry about the turning off the water, like you said, because you're still doing both. Like you're retired and still increasing that income, like you were talking about. Now, obviously, you could do it more, obviously, if you were still working a regular job. But at that point, like you said, no matter if you're super rich, super poor, the only thing you can never buy is time. So you have to figure out when you can actually, safely do it and call it quits there. But
And then there's at a certain point too, I think probably after you get past that sort of 10 or 15-year mark in early retirement of the sequence of return risk. Again, not that I'm spending principal, but that mental part where for me, it's not even the sequence of return risk, because that only really applies if you're spending your principal down, which I wouldn't be. So my portfolio would continue to grow with the market. Um, and so that mental, for me, it's more the mental,
Mhm.
psychological. The first 5 years of early retirement. Okay, can I really make this work? And are my costs lower than the money that's coming in? At a certain point, though, that book, Die. I think it was Bill Perkins, Die with Zero. I don't want to be, nor do I strive to be the richest person in the graveyard. So at a certain point, I will have to spend principal because look, I don't have children at this age. I'm probably not going to have any. And so what am I going to do with that money? Well, experiences and other things. But at a certain point, like, I'm also conscious of the fact that if I'm lucky enough to live into my 80s and 90s, I'm probably not, the data tells you you're not as active at that stage in the game. I mean, look, hopefully I am, but statistically, you're not likely to be. So you're going to be spending less money.
Mhm.
And so you've got to front load that expenditure because what's a couple of million going to be? What value is a couple of million if you don't have heirs and you don't have plans to leave it to charity, or some to charity, but not all of it maybe? What's a couple mil or even more at that point value to you at 90? What are you going to do with that money? I'd rather front load some of that expenditure and enjoy it in my 40s and 50s and even 60s, knowing that I need some, obviously, if I'm lucky enough to live to 95 or longer. But, I'm not out spending the kind of money. What you're spending at 45 is different than what you're spending at 95.
Yeah.
Let's be honest. So
Yeah.
I think about that too. I think about, Die with Zero.
Yeah, I think it was Jeremy. He was my second interview. He's on Twitter all the time. Dividend Stockpile. He's always on there, and he had a really good idea about the whole like setting up the dividend account to your charity, and obviously it's up to them to determine if they use it correctly and do it the right way or not. But like he goes, how cool would it be to have a $20,000 check every year in dividends when you get to the point where you can't spend it going to your favorite charity, and it's you still have more than enough to live, but you're able to give that money every year and you don't have to think about it. So he's like, that was a pretty cool idea that he had, and I was like, yeah, I've never even thought about that. So
Yeah, it's an option for sure.
yeah. Okay, so I think we got like two more questions for you. So first one, I think this one will be a quick one. How important is staying diversified for you, and then what rules do you use to help you with staying diversified?
Yeah, Canada is a pretty small, and globally, anyways, a small portion of the global economy. Canada. I wish the dollar. I mean, there's been historical times in my life when the dollar was on par, so that you could, one CAD equaled one USD, and let me tell you, it was a bonanza because cost of living in Canada, I find, is more expensive for sure than the cost of living in the United States. So we
Wow.
would go down to the US and live like kings in New York City and party like rock stars because I found New York City pretty cheap compared to Canada.
That's never been said.
Look, putting aside real estate, and real estate in Canada is not cheap either nowadays, but New York City, like, I'd go down there and have a great time, and it's pretty cheap,
Wow.
excluding real estate. Canada is expensive.
Hmm.
And so where was I going with this? Was um, it's a small portion of the global economy, Canada. The US, obviously, the S&P, it's just got the titans that, particularly in technology nowadays, that we just simply don't have in Canada. Historically, Canada's had Nortel, BlackBerry, which was obviously, before the iPhone was the biggest cell phone, smartphone, smart, you put that in quotes,
Yeah. Yeah.
phone, but it was the global leader at one point. And of course, that's no longer the case. And the other big one in Canada, Shopify.
Mhm.
So we've had some tech, but not nearly. Our economy is just nowhere near the U.S. economy. I mean, look, we've only now got, given the increase in immigration at the last couple of years, about 40 million people. The U.S. is what, 350 or more million people. So we're just a big second largest country with a very small population. We don't have the economy or that the U.S. has. So I do diversify outside of Canada into the global economy and the US economy, just because Canada is a fraction of the global economy. But I do like the sort of MOTI, if I can use that word, stocks that Canada has. Like,
Mhm.
again, very hard to create a new bank in Canada. Our banking institutions are some of the most financially stable and sound banking institutions recognized globally. They are safe. We don't have these issues in banking and bank runs that the U.S. has had. And so I'm pretty convinced, frankly. I don't do it. I know people that do. Stick all their money in a Canadian bank, 100% of the portfolio. I'm pretty confident. Again, I don't do it. And if I was confident, I guess no, that's a bad word to use, because if I was confident, I'd do it. So I'm not confident, but I'm pretty sure you could stick 100% of your money. I'm talking like millions of dollars into one Canadian bank stock, sleep well at night, because these banks have been paying dividends since the 1800s and increasing them every year. These are, forget dividend kings, if forget dividend aristocrats, these are dividend beasts,
Yeah.
like uh, unheard of. And they're stable, sound, coddled, protected, recognized globally as some of the most sound institutions, financial institutions in the world. So, yeah, there's a bit of that, I guess, in terms of how I invest in Canada, but I do invest outside of Canada just because, we're oil and gas, financials, and a little tech here or there, but nothing on the scale of what the U.S. produces.
Yeah. Yeah. It is. I've heard a lot about the Canadian banks. Like, so some people say the big five, and then some people say the big six. Like, what's
Yeah,
the?
big five, big six. I mean, there's historically, I think it's been more big five, but yeah, big six, sure, you could call them that.
Okay. Yeah, and I know some of them, like you said, have since the 1800. Not obviously not paid and grown, but basically you know that you're going to get a dividend. It's not going to be a Disney situation where you get a dividend one year and then the next year you don't. So, which is
Yeah.
really important when you're planning for dividends and planning to live off of dividends. Imagine some, what was it, 2020 when Disney cut their dividend? Imagine somebody having 30% of the, and this is one of the diversification things that like I bring up to people all the time, is trying to make sure that you're diversified, not only between, stocks and stocks, and obviously the sectors, but also like you don't, in my mind, you don't want too much of any of your dividend income coming from one stock in case of a cut or a elimination of a dividend or something like that. Because, like, what do you do if 30% you were been investing in Disney for years and years and years, and then all of a sudden you have 30% of your dividend income that you make in a year? Say you make 100 grand, 30,000 of that's coming from Disney, and then in 1 year they just cut it. Now you're making 70% on what you used to make, and like what, like that's not a good boat to be in. So
Yeah. In terms of, like, if I'm looking at my top 10 holdings, five of them are Canadian banks.
wow, yeah.
Yep.
But like I said, like that's really cool because like they've paid since the 18, like a lot of them have paid since the 1800s, not the 1900s, the 1800s.
Yeah.
So like like you can sleep at night. Now you might not know what this payout's going to be versus the last payout or whatever, but they're going to pay. It's never going to be a complete elimination because and not never, but they haven't so far.
Yeah. And look, if the Canadian banking sector ever melted down, I've got bigger concerns.
Yeah, yeah.
There are a lot bigger concerns going on if this Canadian financial sector from the banks melted down. I mean, I run for the hills at that point.
It's one of those things where like I tell people, I'm like, I mean, like same thing with you. Like in the United States, if you wanted to put 100% of your money into Apple or Microsoft or something like that, and like they're like, oh, that's too risky or whatever. I'm like, if Apple, which is the biggest, largest company in the world, market cap wise, if that goes belly up, you're gonna have a couple more problems than, oh, my Apple stock went to zero. Like there's gonna be
Sure.
bigger things going on. So yeah, and Microsoft, like how many people, I don't care what country you're in, like Microsoft, what you're saying, the moat of Microsoft, whether it's gaming consoles or the cloud systems they have, or even their operating systems, and like Microsoft Excel and PowerPoint and Word and like all these different things, all the companies that use those, like Outlook, all the companies that use Outlook is ridiculous. Like it's ridiculous the amount of how big their moat is. If Microsoft goes belly up tomorrow, there's bigger problems than, oh, you lost a couple dollars in the stock market.
Sure.
So, okay. So so I like asking this question just to see, like, cause especially with you being plugged into Twitter, like you are there any dividend myths or misconceptions that you do see a lot of on Twitter that you would like to, like, clear the air on or debunk?
Hmm.
I mean, you kind of spoke on one about the whole, like, oh yeah, you have to pay taxes on this, but paying taxes on more money than you would have had is still better. I see a lot
Yeah.
of people talking about like dividend investing is an old person's game or something like that. I see that one a lot.
Yeah. Look, I do think I'm pretty convinced the science and the data suggests you're better off putting your money into an index fund like VTI that tracks the total stock market, at least in the US, than you are dividend investing. Overall, I think you're probably better off doing that. I don't do it. I don't follow that advice, but I know the science and data is there. So there's always that ongoing debate. But again, for me, and we were talking a bit about this before we started recording today, is I'm nearing early retirement, work optional. I will do some work to keep my mind fresh and keep me engaged. But cash flow to me now is more important than I like both. I like growth and cash flow. Like ideally both, the best of both worlds. I'm very happy, but there's some stocks that have underperformed the market, like Enbridge, for example, pipeline company in Canada. They've also got business in the US. And they've underperformed the market, but they pay a growing dividend, and it's been fairly stable in terms of payout. So, am I upset? Yeah, I'd prefer them to be growing and paying and doing everything nice. But look, at this stage, I'm happy to sit back sometimes and just collect the dividend. And if they sort themselves out and become a better performer versus the index, even better for me. But cash flow is king for me at this stage.
Mm-hmm.
So that's where my head's at. I like growth too. I've got that in my portfolio as well. But cash flow of me is much more interesting to me because that gives me the ability to lead my life in a way I want to. Because without the cash flow, you could have a great stock portfolio, but if it's not producing cash, like what are you going to do with it? Like,
Mm-hmm.
you can sell and produce your fake dividend if you like, or some people would call that a real dividend. Fair enough, depending on the side of the fence you're on. But cash flow for me is really important at this stage, and so I like to see that growing. And it gives me comfort to be able to lead a life I want to live that I'm not quite living currently.
Yeah, well, and I think the important thing for people that are watching or that will be watching to take away from what you just said is you said probably 4 or 5 times in that one statement is for me at this point in my life. It's not a, like I said, like we were talking about before. I see so many people that are 18, 20, 25 that are just starting their dividend journey, which is kudos to them for starting so young, first of all. But
sure.
they're doing what you're doing at your point in your life when they still have 20, 30, 40, 50 years still to invest. And at that point, again, it's not the right or wrong decision, but it's an opportunity cost. Like, would you want the cash flow 40 years before you need it? Or would you want, and I'm not obviously my channel is called Dividend Obsession. I do dividend stocks. So I'm not like invest in Amazon or these companies that don't pay dividends. The only company I have that doesn't pay a dividend is Tesla. And I just like Tesla. But that's in my Roth IRA. And all my individual holdings, they all pay dividends. And like I go for the growth and the dividend growth. And then as time goes on and I get closer and closer to needing the income, I can either start taking my new capital and putting that towards those higher income producing assets like an Enbridge or whatever it might be, or I could start selling off of some of those companies where I might have put $200,000 into Apple over the course of my life, but now it's worth $800,000. I can sell that off and put that $800,000 into an income producing asset. And
sure.
that's why I think it's really important to outline what you said there about like at this point in your life, this is what's important. And it's not like this is always important, and things should change in priority and importance as you go through your journey.
Yeah, dividend income was not important to me in my 20s or 30s.
Mm-hmm.
And it wouldn't necessarily be important to me in my 40s, except for the fact that with some hard work, some good luck, and some diligence, and that I've got I'm in a place in my life where I can contemplate earlier retirement. So yeah, income is more important to me today. But if I was contemplating retirement at the sort of standard age of 65, income wouldn't be important to me today either, because
Yep.
I'd be working for the next 25 years, collecting a paycheck, and I wouldn't care about the dividend income per se. But as I'm getting closer to having the option to pull the plug and not work a traditional 9 to 5, still maybe be work optional, income is become much more important to me in this phase of my life.
Yep. Yeah, I super appreciate you saying that, because I think that's a really big takeaway for most people to understand, whether you're new or experienced in the journey of dividend investing. Like, understand, again, no right or wrong answers. It is opportunity cost though. So taking your $10 today could cost you hundreds or thousands of dollars in the future. And is holding that $10 today worth it? So all right. So last question for you.
Sure.
What if somebody's watching this interview today and they decided that they are going to invest, and they decided that they're going to do dividend investing specifically? What tips or tricks could you give them from that tips or tricks you can give them from like the lessons that you've learned in your time?
Yeah, again, if it was, I'd probably do exactly what I did initially, which was I wouldn't. I was actually just having this conversation with a niece who is, I don't know if she's turning 18 or she's close to that age where she can start to do some of this on her own without having to go through her parents to do it if you're under the age of majority. And I was just like, look, stick it in an index fund. And if you want to make it really simple, find a robo advisor that, you fill out a basic survey. They'll test your level of
Your risk
risk,
tolerance.
your risk tolerance.
Yeah.
Now, I suggest ignoring that survey and being risky if you're young. So, you should have either at the minimum, no less than an 80% equity portfolio. You could even be 100 because you're 18 and you've got the rest of your life. So like, go a little crazy when you're younger. Forget the bonds when you're 18. So find a robo advisor and have them your one responsibility as a young person is to find cash, keep your cost of living low, don't inflate it based on what your friends are doing or your neighbors are doing. Keep your costs low, take that surplus cash, just put it into or with your brokerage, and let the brokerage, if you really want to keep it simple, put that money into a diversified index fund for you. Sure, your MER is going to be slightly bigger. So instead of a 0.2, you might be paying a 0.3 or a 0.4, even a 0.5. Sure, you're foregoing a little bit of that money, but it's so small at that stage. And just do that at a bare minimum, and find ways to increase your income as you get older, either side hustle or at your main job. Get experience and grow. And that's what I've done. I started out earning $40,000, and now I earn several hundreds of thousands of dollars in my job, and not including other bonuses and stock and what have you. So grow your income, invest it, keep it simple, early stage, and then as you gain the confidence, knowledge, and education, and or if you want to dabble a little bit and you're young, buy an Apple stock, do a bit of that dabbling, or if you like Disney, buy Disney, or if you really like Aritzia because you shop there, or buy a bit of Aritzia because that's fun to see how it goes up and down. But early on, I'd say stick it in an index fund like a VTI or something.
Yeah. Yeah, I agree with that. Just getting started is the most important thing. And like
That's the biggest hurdle.
yeah, yeah, it is. Yeah, because like no matter, the first of anything is always the hardest. Whether it's the first step to get investing, whether it's your first dollar, your first $100, like all of it's going to be harder than the next whatever you just did. So the next step is always easier than the first. The next dollar is always easier to make than the first dollar. The next $100 is always going to happen quicker than the first $100 in dividends. So getting started is very important. So I completely agree with that. But anyway, so I wanted to say thank you to Dividend Daddy for taking time out of your Saturday to spend with us. And if you have anything that you want to shout out or plug here at the end, feel free to do so.
Yeah, I'll. Thanks for having me. I appreciate the conversation. Always fun. I'll share my Twitter handle, or X handle. I still like to call it Twitter, but X handle is at Dividend Daddy 1, the number 1. So Dividend Daddy 1, then the number 1. And I've got a blog as well, dividenddaddy.ca, not .com, but .ca. And yeah, you can find me at either of those locations.
Okay, cool. Yeah, I'll make sure I put both those in the description below the video. If you guys want to check that out and give him some support, that'd be great. And until next time, we'll talk to you guys later. And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time, see you.